Okay, I think we can begin now, sharp at 3 p.m. IST. A very good afternoon, evening, or indeed morning, depending on which part of the world you're joining us from. My name is Gagan Sidoon, as Director of the Center for Energy Finance at the Council on Energy, Environment and Water. It's my pleasure to extend a warm welcome to all of you to today's discussion on financing the gap between Asian climate ambition and action. I wish to especially thank our panelists who have graciously accepted the invitation to participate. They are Melissa Brown. Melissa joins us from Hong Kong and is a director at the Institute for Energy Economics and Financial Analysis, and she focuses on Asian energy and power market research. She's covered Asian markets for 15 years as an equity analyst at Barclays and JP Morgan, as well as a managing director of research at Citigroup. Joining us from Jakarta, Indonesia is Fabby Tumiwa. Fabby is the executive director of the Institute for Essential Services Reform. He has been working extensively on energy and climate issues for more than 20 years now. He's also currently the chairman of the Indonesia Solar Energy Association, as well as a member of the Sustainable Advisory Council at Gojek. Joining us from Mumbai, India is Abhishek Goel. Abhishek is a principal at Global Infrastructure Partners India. He has over 18 years of experience in the areas of infrastructure equity investments, investment banking, and management consulting. Prior to GIP India, he was a director with the investment banking team at HSBC Securities, leading the power infrastructure practice there. And finally, joining from Paris is John Dulac. John is a clean energy finance analyst at the Organization for Economic Cooperation and Development, where he supports emerging economies in Asia and Latin America to attract investments in renewable electricity and energy efficiency. He's previously worked at the International Energy Agency as well as the Asian Development Bank. Moving to the topic today, the biggest disruption of our times, namely COVID-19, has also brought an already simmering decoupling of renewable energy from other generation sources to the surface. This is manifesting on multiple fronts now. The result is a much sharper investor focus on green today. More capital is now being mobilized towards green than ever before. It's also flowing on terms which are more reasonable than green has ever been able to command in the past. To be sure, on the one hand, several nations actually appear to be on track to meet or even surpass their 2030 commitments per the Paris Agreement. But with fears of a looming climate emergency becoming more stark by the day, this amount of progress doesn't really seem to be sufficient anymore. Much more is required to be done on the emissions front. And emissions, when we talk about emissions is not really a problem of the power sector alone. Electricity is certainly a large contributor to emissions. It accounts for about 40% of total emissions in India today, for example. But so are other sectors, such as transportation and industries such as steel and cement. And in this context, doing more requires two key ingredients for all emitting sectors. The first is to raise ambition. The second is capital to finance it. So just where do the emerging economies of South and Southeast Asia stand today when it comes to both of these aspects? What are the cross-cutting themes that feature across such countries? What are the success stories and what are the learnings? What are the opportunities and what are the gaps? To discuss the above in greater detail, and I'm sure a whole lot more, let me hand it over to my colleague Arjun Dutt, who is program lead at CEW Center for Energy Finance, to moderate the discussion. And in closing, let me also thank you once again, Melissa, Fabby, Abhishek, and John. What's your views on the subject today that we are especially looking forward to hearing today? With that, over to you, Arjun.
Thank you, Gagan. Hello, everyone, and a good day to you, wherever it is in the world you're joining us from. All Asian emerging economies are advancing their respective low-carbon transitions. However, these transitions are not homogeneous, with the planning and implementation of pathways to decarbonize power, transportation, and industry at varying levels of advancement across economies. Just last month, the Indian Prime Minister, during the course of his address on India's Independence Day, noted that the country had crossed 100 gigawatts in renewables capacity, excluding large hydro. However, this is only a milestone on the rather long road to India's 450 gigawatts by 2030 target. Outlining his vision for energy independence for the country, the Prime Minister also flagged off India's national hydrogen mission, marking the commencement of a concerted push to make India a global hub for green hydrogen production and export. India's electric mobility program, though smaller in value terms in comparison to the more advanced Asian markets of China, Japan, and South Korea, is gathering momentum. India sold over 295,000 electric vehicles, mostly two-wheelers and three-wheelers in financial year 2019-20, a figure which dipped slightly the following year because of the pandemic. India has also initiated programs focusing on scaling up domestic clean energy supply chains to reduce reliance on imports for solar PV components and electrochemical storage. Beyond India, earlier this year, we've seen PLN, Indonesia's state-owned integrated power sector utility, signal its intent to pursue power sector carbon neutrality by 2060. While the announcement of this long-term ambition is a welcome development, Indonesia still has a fair way to go towards realizing its existing target of 23% share of renewables and large hydro in electricity generation by 2025. Among other markets, we've seen Vietnam experience blockbuster capacity addition of 12 gigawatt solar PV last year, with a comparable pipeline of wind power in the works as well. However, capacity addition plans over most of the coming decade remain fossil fuel intensive. On low carbon hydrogen, ASEAN nations as a whole in regional fora acknowledge its role in the decarbonization of industry and transportation. While some countries are working towards developing their respective policy architectures, no large-scale programs currently exist. In clean energy manufacturing, Vietnam, Thailand, and Malaysia have established themselves as globally competitive centers for solar PV manufacturing, and more opportunities exist going forward. In the electric mobility space, there is great diversity among ASEAN countries. Malaysia was among the first ASEAN economies with a policy on electric mobility, whereas Vietnam still does not have one. However, the deployment of electric mobility at scale across the region is yet to take off, as exemplified by Indonesia, ASEAN's largest economy, which saw only 250 units in terms of battery electric car sales in 2020. This figure, however, does not include electric two-wheelers. So, some lead while others lag. Nonetheless, all Asian emerging markets need to ramp up their climate finance flows across sectors to meet both existing and heightening climate ambitions. To discuss these very matters, I'm honored to moderate a most distinguished panel today. Melissa, Fabby, Abhishek, and John, a very warm welcome to you all. Part of today's discussion will be sectoral, but there will be considerable focus on cross-cutting issues. Before we get started, for all those attending, please feel free to use the chat or Q&A function to send in your thoughts, comments, and questions, and we will pick on these themes along the way. With that, let's get started. So we'll start with taking a look at the power sector, which like Gagan mentioned, is the largest sectoral emitter. Abhishek, let me come to you first. So your organization, of course, invests in renewable energy in both developed and emerging markets, including India. My question to you has two parts. From your perspective as an investor, with the world as your canvas, what makes renewables investments in India an attractive proposition? At the same time, India needs to at least double its existing annual rate of new project sanctioning to chart a course for its 2030 target. What are some of the obstacles that need to be overcome to realize this higher flow of investments?
Thanks, Arjun, for the very interesting question and more importantly, for a chance to come and present over here. I will take your questions in a way, but I'll just spend a couple of minutes about Global Infrastructure Partners, which is where I work. So GIP is one of the world's largest infrastructure-focused private equity investors. We buy out infrastructure assets not only in India, but also globally, primarily in the OECD countries, managing around $70+ billion of investments for our investors. Now, GIP has globally taken up on itself a very important responsibility of climate change, making our commitment and our own contribution towards climate change. For example, we have voluntarily signed a UNPRI and as a result of that, we are integrating the reporting framework, which is the TCFD, or Task Force for Climate Change Related Financial Disclosures, in our reportings. And therefore, we are slowly aligning our reportings to TCFD. Climate change, we have made as part of our internal policies and our own ESG framework. So from beginning, we were having a very strong focus on ESG, but now we've got climate change into it as well. And right from all the across the value chain of investments, right from diligence, monitoring, review, third-party monitoring, etc. Climate change is a very integral function that we monitor now. On top of that, in November 2020, November of last year, we also were one of the founding members of One Planet Private Equity Funds, which is an initiative by President Emmanuel Macron, which is a fund designed to fight against climate change and meet the goals of the Paris Agreement. So that way, GIP as a global organization is making its best effort to contribute towards against climate change. In India, we have been investing for the last, the team in India has been investing for the last 12, 13 plus years. And renewables has been one of the key focus areas right since the beginning. So your question was why India renewables? We, for example, founded our investee company, which we call Vector Green, in 2016, which was to channel our investments into Indian renewables. And why Indian renewables? Now, India renewable story really started around 2007, 2008. And since then, we have gone through a world of change, right? First, it was tax incentives to wind farms. And then it changed into feed-in tariffs. And then solar came in, initially very high tariffs. And today, solar is probably the cheapest source of power or energy available in the country. So looking at that change in the sector and looking at the growth and looking at the government's commitment and government's focus on making this sector very, very successful, we realized that a lot of investment is going to come here. And not only the investment is channeled towards helping India meet its climate change goals, but there's an opportunity to generate returns for the investors as well, which is why we came into India and we invested a fair amount of money in our investee companies. And going forward also, GIP intends to continue to invest in renewables in India as in other parts of the world. So that was a slightly longish answer to Arjun, your first question about why India renewables. But Indian renewables is a very fast growing sector, which investors, especially infrastructure focused investors like us, cannot ignore. It's a great opportunity to contribute as well as to generate our returns and basically make a difference towards the country's economy. Your second question was, if India has to double its renewable capacity, then what is it that needs to happen? What are the obstacles that come in and which have to be tackled? Now, as in any other business, this business also has obstacles, right? The obstacles may come from a variety of issues or a variety of angles. Regulatory challenges, the government has mainly handled fairly well, especially as we compare with some of the other sectors. But there is a bit of path that has to be followed. There are certain state level issues that are still persisting, which we all hear about every now and then, and those have to be anticipated and they have to be resolved in order to grow the capacity to 2x, because the central government itself cannot take the sole mantle of growth of the sector and growth of renewables in India. I mean, the state governments have to partner with the central government and do it along with them, and that's where some of the more progressive states have led the way, and some of the other states need to follow as well. The other obstacle is financing side, and as we see more and more into the sector, equity financing actually is now fairly well available. Investors in India are well aware of the sector. They are They want to participate in the sector, they want to invest because there is a very strong business case for investment. What's lacking is actually debt capital. And you will find that many Indian renewable companies have to look abroad in terms of dollar funding, etc., to meet their debt funds. And that is because the lenders in India, it's only a handful of them that are providing debt capital to this sector, which needs so much of capital and so much of investment. And that is something, and we can discuss that probably later. I'll keep my remarks short, but that's a second obstacle that has to be captured. And the third one would be that the government is right now trying to manage a couple of objectives. The first objective is how to make the sector successful. The second is how to make the Indian manufacturing successful. The third is its political issues with some of the other countries. And of course, there are, state level issues and all. So we have to prioritize the objectives. You cannot have 3 or 4 opposing objectives and try to solve all of them. You'll end up solving nothing. And that is the other thing that I would mention that has to be looked at in the right perspective.
Thank you, Abhishek. Those were quite insightful. And essentially, you talked about the challenges of the financial condition of the state distribution utilities, and you raised a very important point about the availability of debt financing. And we talked about some of these issues with financing later on in the discussion. But before that, for wider perspective on renewables in Asian emerging economies, let's also hear from Fabby and Melissa on some of the major markets in Southeast Asia. Fabby, I'll come to you first for your thoughts on Indonesia. Now, most of Indonesia's non-fossil fuel-based generation capacity comprises large hydro and geothermal. Solar and wind collectively account for only 300 megawatts in terms of installed capacity. Despite the limited track record, tariffs of 6 cents per kilowatt hour were actually discovered in recent auctions in Bali, and these are 25% lower than Indonesia's average cost of power procurement. Given that competitive power generation is possible, Fabby, what is it that is holding up the deployment of solar and wind in Indonesia?
Thank you, Arjun. If we look at the renewable energy development policy in Indonesia, look at that from the 80s, that actually the government has been set some renewable energy target and development. And we know that geothermal has been developing since 1980s. Although now geothermal is only like 2.2 gigawatt in total, as well as hydro, and that because of we know oil crisis back in late 70s. So when oil crisis happens, Indonesian government, first Indonesia energy policy in 1981 is actually mentions about diversifications of energy resources, because at the time we are still oil exporting country. We are part of the OPEC, and we produce like 1.5 million barrel per day. So instead of using that domestically, it is better to export as it brings revenue. So that's why then the government would like to develop indigenous energy resources, which is renewable hydro and geothermal. But at the same time also, we start to utilize our coal resources. Later on, after the economic crisis, 1997, 1998, then coal become a big commodity market, and we are one of the have the largest resources. And we see after that coal utilizations become dominant in terms of utilization, but also export commodities. And at the time, I think the government in 2000 and early 2000s, Indonesia started to have declining in oil production. So instead of being oil exporting country, we are become net oil importer countries, actually starting in 2024. And again, in that situation, then the government, our energy policy shift into massive utilization of coal. Back in those days, renewable are still very, very expensive. We talk about wind and solar is still very expensive, and the government start with this fast track program one, the first fast track program one in 2006, aiming to increase a coal-fired power plant, followed by the fast track program two, another 20 gigawatt. The first one is 10 gigawatt. The second one is 20 gigawatt, but half of it was actually for geothermal and hydro. And then later on, 2014, we have this, 2015, we have this 35 gigawatt. So that's the story. So why, so if you look at the number, that solar and wind is still very limited, not because we don't have that resources. Well, we have some wind resources, but not compared to India. I think our wind resources is marginal, but we have plenty of solar. Even our study shows that we have the potential based on land availability. In Indonesia, we can generate technical potentials like 20,000 gigawatt, far larger than the government-owned resource estimation, which they currently are revising. So solar is very, very infant. And if we look at the from the political economy perspective, because coal so dominate, and we have single utilities called PLN that supply 95% of the electricity in the countries, and they prioritizing a coal development. And now with the 35 gigawatt already come to the most of the project already in constructions, and some of them already in operations. It's kind of a very difficult to add more renewable energy. Although right now the government, well, since 2014, the government has set a target to reach 23% renewable energy by 2025. So that's actually is a good sign. And if you look at the latest policy development, as Indonesia also has stated to reach net zero emission 2060 or sooner. And as you heard that our president has instructed to no longer no new coal projects after the completion of 35 gigawatt. And so we will see that more renewable energy, in particular solar, which I see the government has came up with the new new national energy strategies that being discussed to respond with this decarbonization target. I think we will see more solar and other renewables is actually are in planning right now. Well, it will take some time until it will become a project, but so far the discussions of PLN 10 years capacity expansion plan has shown that renewable have a larger share. The latest draft that I saw actually adding like the renewable is 51%. Compared to 49% of thermal power, which is the remaining of 35 gigawatt project.
Okay, thanks for that, Fabby. So of course, there is the overhang of the existing and projects in the pipeline in terms of thermal capacity, but perhaps some of the new plans for future capacity addition offer some promise. Melissa, let me come to you next for some perspective on the other Southeast Asian markets. What's worked and what hasn't in terms of attracting investments in renewables? Melissa, you're on mute.
And now I'm unmuted. Thank you, Arjun. I want to pick up on something that Abhishek and actually Fabby just, I think, highlighted, because we're all students of this, but it's really humbling the extent to which the basics really matter, which is the whole issue of energy transition and the factors that can lead to an acceleration of uptake of renewables and more available financing. Really, at its core, it's about political economy. It's the political economic puzzle. And I think Abhishek said a really interesting and important thing about the importance of governments in a perfect scenario of operating with some priorities, and priorities that can be consistently expressed, because the political scenario on the ground across the region, especially in the COVID period, is complex, and the trade-offs are tremendously sensitive at this stage of the game. But when I look at the rest of Southeast Asia, and I have the benefit also of having a really strong team that looks actively at India, so I'll try to triangulate a little bit from what we see in India and what I do and don't see, say, for example, in Vietnam and the Philippines. If you sit on webinars these days with infrastructure investors and people excited about green finance, and if the moderator plays the game at the end of, hey, developers, people like Abhishek, which markets do you like? It's a pretty predictable response right now. People almost always reference Vietnam as the market that's most interesting. There are, of course, problems. But Vietnam tends to be top of the list, and I'll talk about some of the reasons why. And the Philippines also has a fairly interesting story that comes with it. So because we're looking at this issue of how do you accelerate renewables, we're looking at a specific angle. But the context for the energy growth markets of Southeast Asia really has been a political puzzle, very, very focused on how to work with limited capital, limited domestic capital markets, lacking real depth, and the need to attract foreign capital. And as a result, a lot of what we have seen to date, whether it's Vietnam or the Philippines, has been, in effect, the best, although I think deeply unsatisfying answers that reflect the work of the last 30 to 40 years in terms of how infrastructure is financed. So a lot of the capital that's been made available to the Vietnamese and to the Philippines has come almost exclusively through IPPs. Neither Vietnam nor the Philippines is investment grade. Indonesia is very fortunate in being investment grade. But they've had to work very actively with the Japanese, with JBIC, with the Koreans and KEXIM, with the Chinese and CHEXIM. And they've had to work with private sector capital that can be mobilized with a lot of credit enhancement, and ultimately, always with a sovereign guarantee and a 25-year PPA. And it has had to work in the context of what did the North Asian partners want to sell? They're willing to subsidize these transactions, but they wanted something in return. And what they wanted was the ability to leverage off their very considerable industrial infrastructure to manufacture power equipment. So if there's good news in there, it's that a lot of this capital was provided at ultimately relatively low cost. If there's good news in there, it's that increasingly, particularly over the last 5 to 10 years, the thermal power capacity provided is ultra super critical, or at the very least, not subcritical. But we've had a very limited window through which these countries could raise capital. And unfortunately, during the same period, we saw very, very little institutional interest in North Asia at trying to work with countries like Vietnam, the Philippines, or Indonesia in terms of creating the right conditions for renewables. But that is in the process of changing. And it's changing for a reason that really links again to the politics on the ground. We're now approaching the point where renewables can solve real problems and can solve some of the most important ones for policy sector planners. One is that, tactically speaking, new renewables capacity at appropriate scale on a modular basis can now be plugged into the grid on a much faster time frame than we can see with typical large-scale thermal power facilities. So it's essentially more modular. It can be mobilized more quickly. And there are now, and Vietnam has been a huge beneficiary of this, because there is beginning to be real confidence in the ability of planners in Vietnam to create positive conditions for renewables. You have a number of Southeast Asian corporates, international investors who are willing to take risk. And they're willing to bootstrap if necessary, balance sheet finance for periods of time, work with Vietnamese banks. And we've seen actually something that I, as a finance person, love to see, which is we've seen a lot of pretty scrappy, very innovative financing packages put together, oftentimes very quickly, in order to get access to Vietnam's renewables market. That has been an attractive proposition, particularly for corporate investors, because they can see opportunities for scalable growth. It still looks relatively small, but I think that in many ways replicates what has taken place in India. You know, a lot of it was corporate money flowing early, sometimes local banks, sometimes major banks, sometimes the program banks, but that's solving a real problem now. The second point I'd make in the case of the Philippines to watch for is, although the Philippines has excellent renewables potential, and there's some very interesting things that have the potential to happen there with some big bets on storage, it's really important to keep in mind that power in the Philippines is extremely expensive because they have no meaningful domestic fuel. So if you're looking at developing renewables and you're having to work against 18 cents a kilowatt hour, you've got a pretty good window. And if you're a politician or a policy planner, you have very tangible reasons now to be saying, wait a minute, I think renewables, especially if it's mobilized in the way India has, with competitive auctions and more transparency, can start solving real problems in our power market. So those are two trends that I look at. And again, you know, Fabby said it right. It's about political economics.
Thanks, Melissa. Let me bring in John at this point. John, based on Melissa's remarks, it seems that the risks facing investments are actually rather similar across emerging markets, and they only vary in terms of their severity. And she also referred to the fact that many solutions the solutions for bringing in investments are actually rather standardized and can be applied across markets with, of course, due considerations of local factors as well as the political economy. So the question is, how can countries benefit from the sharing of experience and expertise? How can this be enabled? If you could talk a bit about that.
Yeah, thanks, Arjun. And I think you make a very important point there. And it's particularly to second what Melissa was saying, that there's huge opportunity, and a lot of this depends on both the market framework, the policy conditions, and I would add to that as well the uniqueness of each country. There's lots of lessons to be shared, but I'm not sure at the same time that there's something that can be grafted from one country to another and works exactly the same way. And there's, in each of those stories, if you will, lessons that can be extracted and perhaps tweaked to find the appropriate policy tools or the appropriate financing instruments in a way that makes them effective in that market. And I think already in listening to some of the examples we've heard on Vietnam, on Indonesia, on India, the Philippines, that all of these point to the fact that the end goal is very similar, but perhaps the steps towards it are different. And I think dialogues such as these, a number, for example, of focus group discussions that our CEFIN program has had with the Indonesian and Indian governments, these are the ways to bring forward those questions around what works or doesn't work, and more appropriately, I would say, how to make that work in the national context. Just to take an example there, I think what's happening in Indonesia is really quite brilliant, that they have tried, similar to many other countries, things like feed-in tariffs and now auctions for renewables, but that the context, particularly with domestic coal production, very low energy prices, risk that many countries, of course, face with things like foreign currency hedging, that these are not necessarily being managed in a way that is attracting really large-scale scale-up of private capital in Indonesia for renewable projects. And that through those types of dialogues, in fact, what has come forward is the need, for example, for the forthcoming purpose on potentially the renewable energy law to address some of the market barriers that developers and project investors are seeing. I think as well, if we look at the Indian context, for example, the progress with auctions is absolutely astounding. At the same time, we can also say that this has to a certain extent limited development of rooftop solar, which in fact 10 years ago was doing relatively well in India. So on top of what I think has been said by the other participants and how we can take these international lessons and dialogues in fora such as these, the piece that I would add is that all of these should be seen as essentially as an evolving framework. There isn't a one-stop shop that essentially fixes this forever. I think it's knowing the market, assessing where things are going well and where there might be a need for push, and then also reassessing them moving forward. So that we tap into those opportunities, especially since we know in Asia in particular, as the major demand market for future energy in the world, that these opportunities won't stop. So if we create the right enabling frameworks for them, they will continue to flow.
Okay, thanks, John. Thanks for that. So let's change gears quickly and talk about the broader low carbon transition. The ecosystems for broader decarbonization beyond the power sector, including policies and markets, remain in nascent stages across Asian emerging markets. While compliance with national level climate change mitigation plans can contribute, economics, either as a carrot or a stick, can be a more compelling catalyst for the development of ecosystems around electric mobility, low carbon hydrogen, and clean energy manufacturing. The question remains, are these carrots and sticks compelling enough to trigger large-scale decarbonization? If one examines Asia's economic trajectory, exports have played a key role in driving growth, particularly in the ASEAN region. However, climate change itself could bring new challenges on the international trade front, with the EU set to impose carbon taxes on imports from 2026. These border carbon taxes would penalize the embedded emissions in imports from jurisdictions with lower environmental standards. Lawmakers in the US are also contemplating similar legislation. Melissa, I want to start with you on this. What kind of an economic impact can these border carbon taxes have on ASEAN exports? And are these compelling enough reasons to actually trigger the development of more concrete pathways for the decarbonization of industry?
I'm not sure that I have a unique view on carbon border adjustments, and I'm certainly no expert on the details. I'd happily defer to John or anyone who looks at them more carefully. But I have really quite a simple view. I'm not prepared to argue that I think with high probability that this is in fact what's going to take place. But I am delighted that this discussion, that this policy discussion is in place, because I think it creates some incredibly powerful incentives. And they're not entirely fair. There are meaningful and important equity issues that I think, people like Fabby could highlight probably better than I could. But when I look at the markets in Southeast Asia, there is no question in my mind that the diplomatic threat, if you will, of carbon border adjustments is having a meaningful impact, but it's having a rather predictable impact as well. If you're Vietnam, and one of the things that is absolutely sustaining and differentiating your growth trajectory has been your ability to attract hugely significant foreign direct investment and growth in your supply chain manufacturing sector, especially as you benefit from some of the migration out from China. The sensitivity of the Vietnamese policy planners at this stage now to the need to be able to provide clean power at a reasonable price, that is beginning to be an overarching policy imperative that the Vietnamese planners are, in a very balanced way, trying to respond to. And this message is being given to them very, very consistently. That links directly to the types of incentives that would be creative or, if you will, enforced as a result of a carbon border adjustment. I think Vietnam is further down the track in terms of thinking about it as a result. I'd also stress that there's a reciprocal issue there with the carbon border adjustments, which is this question of, do these different countries have a domestic carbon market or a portfolio of policies that would help them meet the evidence case necessary to begin to adapt to this type of proposal. The Vietnamese are certainly hard at work on it. Other countries in the region have taken preliminary steps. But again, this is going to move very, very quickly into some tough political choices. But the work is ongoing. One point that's very sensitive at this stage, obviously we have COP coming up. We have a lot of relevance to all of these issues. Many governments obviously are already working at their policy management limit as a result of COVID. I'm pleased to say that, you know, countries in the region have been hit hard, but by the same token, policy work continues. I do think we will see some important things, but there are building blocks to this process where Europe is clearly extremely advanced. And Abhishek, you touched on this at one point earlier, which is the data necessary. For anyone who's watching the development of China's carbon market, keep your expectations simple, keep them practical. You can't have an effective carbon market when you don't have appropriate data and where you don't have transparency. China is hard at work on those building blocks. Vietnam, the Philippines, other regional markets are only just beginning. So I think this will be a productive process, but I'm not really expecting to see Europe or the US really be able to successfully take this very far right now.
So let me come straight to John. He's had his hand raised. So John, maybe if you can respond to Melissa's comments. And I mean, she particularly raised the point about the carbon markets. And China already has an emissions trading scheme in place. It only applies right now to the power sector, but perhaps it can be extended to wider industry. So what are the pros and cons of carbon market as a means to decarbonize industry in India or ASEAN? And any other comments that you might have in response to Melissa?
No, we'll let policy makers make these decisions, but I think the point, as Melissa said, is that these conversations are now happening. And what I would add to that is that they're happening within, I would say, a wider purview of discussions around how to push forward the agenda of meeting our sustainable development targets in a way that is different, perhaps, than conversations leading to the COP in Paris 6 years ago now. And more of looking towards implementation, which in particular is questions around how to measure, verify, and validate the actual progress, and equally how to get the finance sector to start taking this seriously. And on this point of carbon markets, I would add that I think within a much wider scope is obviously conversations leading to COP26 in Glasgow around what will be the signals and the requirements for investors moving forward. Not just in this sense of making fairer play. And I think this is one of the conversations happening around things like a carbon border adjustment, that you have industries, for example, in Europe, who are saying that we're happy to do this here, but of course, if the rest of the world doesn't, this makes things expensive for us and we're not competitive. But I think equally the other way around, you will have a number of investors, portfolio managers, and even companies that are actively engaged in Asia, who will start asking this question of, do I have access to clean electricity? Will I be able to say that my portfolio is aligned, for example, with the EU taxonomy? And I think, as Melissa said, the important piece today around those conversations is not necessarily that everything gets solved overnight, but that the frameworks start to be built moving forward, and equally that the data that will be necessary behind these is available. And that will be the critical place moving forward. It's great to say you want something like a carbon border adjustment, or that you want sustainable finance reporting and disclosures. But if there's no solid data behind that, or if it's questionable data, this is going to create big risk in the finance markets, which will only, in my opinion, slow down, if not hinder, some of that potential progress that would naturally happen because of the movement towards those green assets. So I think the important piece there is that all countries, not just in Asia, but everywhere, should really be looking at this in a way that we can start proving that those investments and those assets are in fact worth our time moving forward, and that they actually do deliver on what they say they promise.
Right. Thanks, John. So I'll move on from the sticks to the carrots. And actually, Melissa already mentioned the opportunity with regard to geopolitical tensions between China and the US, translating into restrictive trade policies on Chinese clean energy imports into the US. So do these geopolitical developments offer India and ASEAN countries an opportunity to scale up their clean energy manufacturing? I'll pose this question to Fabby and Abhishek in turn. Fabby, coming to you first. ASEAN countries, particularly Indonesia and the Philippines, are well endowed with minerals such as nickel, cobalt, and lithium, which are, of course, key components in the development of lithium-ion batteries. How do policymakers and industry in the ASEAN region view this opportunity to increase their presence in clean energy supply chains?
Yes, in Indonesia, we have seen that, well, part of this target with the electric mobilities, then the government has established battery companies. And the plan so far, what I understand from the government plan is that to create this integrated supply chain in Indonesia. So from raw material, nickel, into ferronickel, processing it, and battery industry and electric vehicle manufacture. So that was the intentions. And so far, I think it's start moving. Indonesia Battery Corporation has established a couple of months, and they start to produce this battery in 2024. At the same time, then the government secure investment commitment from battery makers that was from Korea, and also electric car manufacturer. So we see that the intention is to build the local industry capacity to meet our future demand in electric mobility. Focus so far is actually in the electric car, very few on the two-wheelers, for instance, but it will take some time until the industry develop. But there's a strong policy support behind this, and also the government mobilize support from a state-owned enterprise. So if you look at the whole battery industry, is actually joint ventures of state-owned enterprise, our PLN, State Oil Gas Company, mineral, the holding of mineral companies, and I think is a coal company also join in that consortium. It will take some time because we only produce nickel, but we know that for battery it will also require lithium, which Indonesia doesn't produce at all, and we don't have that resource at all. We only have nickel and cobalt. But also, if you look at the processing, the smelter, actually for this, you have local investment, but also a number of quite significant presence of investor from China. So they actually dominate, I can say, 80% of investment in nickel processing in Indonesia. And that's also one of the issues with the EU, right? I mean, with the that Indonesia decided no longer export nickel to EU, and that's become dispute. Recently, it still has to be resolved, but I think the Indonesian government firm stated that we will use that for our domestic. It's also part of the what we call the downstreaming policies in downstream industry policy, which also required by our mineral and coal law.
Thank you, Fabby. Thank you for that. Abhishek, let me quickly come to you on this before staying with you for another issue that you raised previously in the conversation. So how does the industry in India view the opportunities associated with clean energy manufacturing?
So I'll answer the question, but it's quite interesting because, in other countries, people are, and Melissa and John also talked about that countries are thinking about carbon tax to disincentivize the polluting industries in favor of the green and green industry. But in India, I suppose the pendulum has swung the other way. All the government has to do is announce a project and say that you will be paid in time. And lo and behold, there's a long list of developers who come in and try to bid each other out and win the project. So, I mean, gone are the days when viability gap funding and government support, etc., were required. Now people are willing to pay all kinds of taxes. We've got safeguard duty, we've got goods and services tax, we've got income tax. I mean, clean energy is paying its taxes, and it's paying actually the government for doing business in India. So while I agree that carbon taxes, etc., will help and provide much needed capital to the government for encouraging non-polluting sectors, but the clean sector itself is paying for itself. So that was just one comment I wanted to place. And on your question, Arjun, see, clean manufacturing in India has had its own ups and downs. India has huge capacity of manufacturing wind equipment, for example, right? But not so in terms of solar modules or solar equipment. And there's a reason behind that. Because initially, the way policy was developed, I mean, there was a huge incentive about if the wind equipment is manufactured in India versus imported. And wind equipment is, of course, much more massive and costly to import. So it made sense to make it in India. Solar modules, on the other hand, are easily tradable across borders. But now the government is pushing the industry to set up its own manufacturing in India instead of depending upon imports. And the industry has, in fact, taken up the mantle and is looking to invest large amounts of capital and effort into manufacturing. So we've got almost all the large business groups of India looking into solar manufacturing. I mean, a couple of days back, Reliance Industries has purchased a very large company in Europe, which is called REC, to assist them in get capabilities to do solar manufacturing in India. So I think the Indian industry has taken this up as a challenge and as a profitable business venture to do manufacturing in India, especially for solar. I'll just make a point on to what Fabby was saying around EVs. EV manufacturing in India, I think, is still at a nascent stage. We've got manufacturers who have years and years of experience making batteries, but those were, the typical automobile batteries and not one of those, the batteries which can take this kind of grid load, etc. But some steps are being taken, though at a very nascent stage, because the raw material in India is not as widely available as, say, in China, for example. So that's what I think.
All right, thanks for that, Abhishek. I'm actually going to stay with you, like I promised, because you raised a very important issue before. So, of course, we've had a comprehensive look or a detailed look, detailed enough for a panel discussion on the sectoral issues. But coming to some of the cross-cutting issues, and Abhishek, you mentioned previously that one of the challenges in the Indian market itself, and which also applies to some of the other emerging markets, is that sufficient debt capital is not necessarily available, or there aren't any clear enough pathways towards accessing the debt capital. So, of course, the GIP-backed company recently closed a domestic bond issuance in India. So perhaps you're ideally placed to talk about the challenges associated with raising capital in India's debt markets, and what are the possible solutions that you see that can help advance the market. So over to you.
Sure, Arjun, thanks for that question. Yes, it's true that one of our investee companies, which is called Vector Green, did a very landmark bonds issuance within India to the domestic debt investors of India. And it was a resounding success. We raised funds at 6.5% rupee, which is probably the cheapest debt capital in the country raised by any renewable developer anywhere, anytime in history. So we did that and we were quite happy about that. And we did that for a reason. I mean, till date, the only two sources of debt capital that was available to renewable energy players was, the first one was capital from banks, which was the traditional lenders. And over the years, some of the banks who used to lend are not lending enough because they've reached their infrastructure sectoral limits, and they're risk-wise, they're not comfortable lending to renewables anymore. So that leaves a very small number of lenders who are still lending to renewables today. Most of the larger renewable players have accessed the dollar capital markets in Singapore and Hong Kong to raise USD bonds to fund their own debts. And this debt, of course, is in dollars. And while the entire business is in India and revenues, etc., in rupees, it exposes them to a fairly significant forex risk, which has to be hedged, and the hedging cost has to be built in. So what we thought was that we'll try to see if there is appetite in Indian debt mutual fund and debt capital market investors to really look at green energy as a source of their investment. And so we launched this process. And what we found was, being first in the market with such a high quality portfolio, and we were rated AAA incidentally by 2 rating agencies. So when we went out in the market, people were very, very interested in talking to us, understanding what the issue is, understanding the credit, et cetera, But, we also got our bonds rated green certified by Climate Bonds Initiative. But what was most surprising to us was that nobody really looked at the green aspect. I didn't even have one single question about the green rating from any investor. And we spoke to 30, 40 investors, right? Not even one guy even wanted to know what Climate Bonds Initiative is and what the green rating implies. What we do differently that we are green and nobody else is green. They didn't care. So all they thought was, traditional way, what's the rating, what's the risk, what's the economics, how good or bad is the management, et cetera, and that was surprising. And that's what created kind of a motivation for us that we will go ahead and with this issuance, and we will lead the path for many other renewable developers, and we'll try to create awareness in the investors that, look, green cannot be treated in the same vein as say a coal-fired power plant, which is what it is today. So that was a bit of a a learning for us, and that's what we are trying to do. Whenever we talk to our investors and whenever we talk to the market, we are trying to raise awareness of that. And we believe that some nudge from the regulators or from the government side could be useful, and that could open up a significant opportunity to raise debt funding for other renewable players.
That's actually very thought-provoking, Abhishek, and I'm going to go to John because he's going to talk about all that matters regulation. So John, while Abhishek was making his remarks about investors not caring at all about the greenness of the portfolio, but just the credit rating, I was reminded of something that I heard Mark Carney, of course, the former governor of the Bank of England and current UN Special Envoy on Climate Action and Finance. In a podcast lecture on the BBC, he mentioned that the financial system as a whole is funding temperature increases of over 3 degrees centigrade. Now, of course, the status quo is not something that is consistent with a sustainable future. But as Abhishek mentioned, perhaps there is a role for regulation to play a role in guiding some of these investment flows in the right direction. So, of course, particularly the EU has sort of led the way in the shape of working on a sustainable finance architecture that does just that. Align mainstream investment flows, or sort of bring mainstream investment flows more closely aligned with climate goals. So could you talk about some of these initiatives or frameworks and how they help direct the capital flows, and perhaps even comment on, or maybe I can bring Melissa in for that, commenting on how they apply to markets in Asia, in the ASEAN region or in India. So over to you, John.
And thanks very much, Arjun. And I think this is an important point, one that I would point out as being a bit hypocritical currently. And I say that lightly, but I think it's important that it is a very rapidly evolving space. If you look, for example, at the government recovery packaging across a number of countries, The IEA estimated in the beginning of this summer that only about 2% of that was actually aligned with the clean energy transition. So, there's a lot of finger pointing, if you will, that can be had. But I think at the same time, there's also a lot of very good will and progress in the discussions leading to COP26 about how to treat this moving forward. And some of this, it very much does point to this point of regulations and market signals around work that, for example, is happening with the Fed in the US, the EU taxonomy that I mentioned here in Europe, which now is a legally binding framework and will evolve with a number of proposed measures, such as the corporate sustainability reporting for all companies that are listed, and how they have to account for what they're doing within their portfolios. I think equally, private sector initiatives, like, for example, RE100, with corporates looking to be able to say that they're clean, not just to their stakeholders, but also for a number of other reasons, including, for example, things like their reporting here in Europe under the Sustainable Finance Taxonomy. So these will start to take impact. And I think the particular point is it is an opportunity space for things like renewable development in Asia. We know already that a number of projects in countries like India, when they have gone to issuance, for example, for green bonds, that they've been oversubscribed. So there is clearly very big appetite to say that things are green. And I think increasingly what will happen moving forward is that we'll see these types of policy frameworks coming out that either nudge or force the hand on some of this. And so, as I mentioned earlier, I think, and very much to Melissa's point, this, there's space here for countries to get their houses in order, if you will, to make sure that data is available, and equally for project developers to see this as an opportunity to sell themselves for investors looking for those green assets or labeled assets. I would just add to this quickly, I think, particularly within this comment around what was happening, as Abhishek mentioned, in India, that it's not just about the labeling. I think equally there are a number of factors that need to be considered when putting together these potential investment packages for a number of actors in this space. The case in point being that the label itself might be helpful, but they're still looking at risk. They're still looking at company profiles. They're still looking at credit ratings and sovereign ratings. And we've seen from experiences in a number of countries that this can mean having to develop a number of potential ways to at least initially help drive the market, whether this be things like insurance or guarantees, collateralization of certain projects, proposals, for example, for things like a credit enhancement mechanism in India that can help this market. These are the types of tools that will facilitate those investments. The label itself is certainly a plus, but I think in the short term, making those investment frameworks and those potential instruments work is the critical piece.
Thanks, John. I'm going to come back to you on that credit enhancement towards the end. But first, let me just get to Abhishek. He's got his hand raised. I'm going to quickly come to Melissa and Fabby after that.
Thanks,
Abhishek,
John.
please.
Thank you. I just wanted to clarify, John, my comment that it's not just a matter of label, and it's a matter of the actual portfolio that is in the market, right? I mean, and I'll just mention another fact that when we were in the market, there was another issuer in the market who had a road, right? Like road is a is a carbon neutral thing, so as to speak, but we were fully solar portfolio, and using the capital to free up some of the money which would go into funding more new solar capacity that we are funding. So when you compare a roads portfolio on one hand, similar rated, and our portfolio of solar similar rated, the investors were indifferent to both, and that came across as a bit of kind of unfair to us, that the climate change was not a factor in their mind at all. So that was my comment. Thank you.
Thanks for that, Abhishek. Melissa. You're on mute, Melissa.
Abhishek touches on something that's really important, and of trends that I would like to see gain momentum in Asia, probably number one on my list. And I think it will require more focus from investors. Is simply that fixed income investors in the Asian and Southeast Asian region really have not kept pace with their global counterparts. And I think they're still to a degree, at a pretty preliminary stage of the learning curve. And they're Abhishek, as you figured out, they're pretty unapologetic about it too. They're not ashamed that they're ignorant about this. They're like, why would we care? And if you're looking at these trends regionally and globally, it's almost reaching the point now where it's a little shocking. And I think that we have a number of parties that haven't taken the steps they need to take. So part of that, I think a little bit of the blame and the pressure needs to sit on regulators. I also think some of the biggest asset owners in the Asian region, an awful lot of, as you know, there's a lot of infrastructure debt, local currency infrastructure debt in this region has gone to insurance companies and national pension funds. And they have lagged. And it's no longer a joke. It's deeply problematic. If you want to look at an example where we're beginning to see movement, and I say this with years of experience of sometimes getting any prediction about China wrong, I'm beginning to see some very, very strong trends on the Chinese side where high-level economic regulators increasingly equate steering capital toward greener issuers as being a very, very tangible response to prudential risk limits within the system. That there's almost an imperative now in the Chinese context. They've started from a relatively low base, but the work has been steady. It's looking more relentless and more forceful than I would have guessed even 12 months ago. So I do think we are beginning to see significant systemic policymakers take this message on board, because if you don't begin to steer the system, it's a problem. Another fascinating gap, and again, Fabby, I'm going to go briefly just onto the Indonesian territory, but one of the most striking things is the reaction from the high-level Indonesian financial policymakers has been to really, really improve the solvency of Indonesian banks. Well, they've done such a great job that the return on equity for Indonesian banks is amongst the highest in the region. And quite frankly, they simply do not lend to renewables ever, because they'd rather lend to, and they make more money on consumer loans. Again, there is no regulatory incentive. And so one area of things that on my wish list for green capital and sustainable finance, as we move a little further down the line, ideally, John, with more of the framework that we're beginning to see from the EU coming into Asia. But I'd love to see pools of sustainable finance mobilized at the sovereign or just sub-sovereign level that will really work at the export credit level and will really begin to provide pools of capital that have targeted uses that will unlock some of this capital, either broadly within the financial system, but I really truly think it needs to be accompanied by work from the regulators of the banking sectors, the insurance sectors, and it's very sensitive, of course, but some oversight of the pension systems, because it really does worry me. If people ask me straight up, where do I think all the carbon risk has gone in Asia and Southeast Asia? Tragically, I think a lot of it's gone into the pension system. And I really struggle to understand how that's going to be a positive thing.
Fabby, I'm going to come to you next to firstly respond to Melissa's comments, but also talk a bit about, John mentioned some of these mechanisms such as credit enhancement and guarantees to get capital flowing in sectors where there risk. Of course, Indonesia has such PTSMI with such a mandate. So could you comment upon, using that as an example, the capacity of local institutions to actually undertake risk mitigation at scale? Over to you, Fabby.
Yes, there's a number of efforts that government has been doing in the past few years, try to address all of these risk issues. The government has established IGF, Indonesia Investment Guarantee Facilities, was developed together with support from Asia Development Bank, I think, more than a decade ago. And there's a lot of, and also with PTSMI, which supposedly act as or function as development banks, development finance, I think. And they also has been asked to or tasked to develop kind of a credit enhancement facility, which is embedded in their finance in their scheme. So I mean, we are still developing all of this. The instruments. I mean, it's not perfect right now, but I think it's coming. But the issue with Indonesia, I think, despite this, and also this to respond Melissa question, why a commercial bank in Indonesia they have a very limited portfolio in clean energy, in particular for renewable energy, because what is absent is actually bankable project pipelines. That is actually the main issue. And we have heard time to time that banks they are willing to fund, because we have this sustainable finance policy since 2015, and now it's in the second I think in the second term after from 2021 to 2025, I think, with focus now on the green taxonomy. But the bank has been encouraged, and frankly, there's a still very limited number or amount of portfolio being channeled to renewable energy. But the problem is very limited bankable project. That one. That second, also Indonesian bank quite conservative. I think they don't want to take a risk, and so it's also part of our system that they prefer to buy government bond and sit with, I mean, just keep that money. They will get return anyway. We don't have to take any risk. And I think it's being criticized that the government allow banks to buy the bond, and in return the bank just expect that they will get coupon from this bond, right, rather than take a risk and finance project. So I think it's the problem is well known, but then that's, but this is about the entire ecosystem, because any bankable project, it's depend on policy, regulation, electricity tariff, and that's true that Indonesia electricity tariff is one of the lowest in the Southeast Asia. The average is around 10 cents per kilowatt hour, and that's actually very challenging for any bankable for project, because PLN as the only off-taker right now always set what level they are prefer to buy for the electricity from renewable projects. So it's very difficult for a developer to meet with that, as well as in the past we have inconsistency in our regulations. Well, in Indonesia, I think very famous that every minister changed, you also change the regulations. And that's actually, if you look at the fit-in tariff policy in Indonesia, which is quite compared to other ASEAN countries, we are the first one that implement fit-in tariff policies back in 2008. But now we are like go nowhere with this, because it's always flip-flop. Yeah, and I think that's the challenge. That's actually the challenge with the financing from the bank, as well as instrument like green bond. That's the same, because there is no project to be financed, so there's still limited green bond issued in Indonesia.
Thank you, Fabby. I'm going to come to John for the last word. So Fabby mentioned the limited capacity of local institutions to actually underwrite risk and actually take on the risk. Can international capital sort of fill this gap, John?
Yeah, thanks, Arjun. I think, to Fabby's point, as well as to what Melissa was saying, that it's not just a question, obviously, of having the right regulations and policy signals in place, but equally about how to use public monies in a way that enables larger investment with private capital. And this is, of course, a lot of the work that our Clean Energy Finance and Investment Mobilization Program is working on with emerging economies, particularly in Southeast Asia. around ways in which we can apply international funds, for example, coming from the Green Climate Fund, which is supposed to be, as of last year, 100 billion a year. There's a lot we can do with these monies, and they are quite large sums, but at the same time, in the grand scheme of things, looking at the trillions of dollars that we need for the energy transition, this clearly will not suffice. There does need to be a way to engage things like pension funds and private capital. And if, as Melissa is saying, they're looking at this and saying, so what? Then we clearly haven't created the environment that appetizes those types of investments. And I think, as I said, maybe as an opening remark, that this will depend a bit country by country. If we look at, as was mentioned in Indonesia, the need to develop an actual pipeline, the problem is not per se that people want to invest in those renewable energy projects, but there aren't enough of them. And the use of international development funds and working with partners can actually help to create things like project preparation facilities, so that those projects are done in a standardized way, using documentation that investors are familiar with, and that reduce a lot of the perceived risk of investing in those projects. I think in other countries like India, for example, as we look at particularly the solar and onshore wind markets, there's need to start recycling some of that capital with huge opportunities to tap into institutional investors. But that some of this will mean addressing things like, for example, currency exchange risk, or equally, again, the need to have those standardized in a way so that they can be bundled and sold as aggregated assets. Some of this also comes to work across countries to share experiences with things like regulatory norms for things like asset-backed securities, where again, in the case of India, my understanding is that RBI regulation does not explicitly say that renewables count the same way as mortgage-backed securities do. So, these are issues that come across when you start delving into the details around how to make capital flows happen. And I think the opportunity, particularly for emerging economies in Asia, is that there are these international funds that can support these. And there are a number of international lessons around how those international funds have worked quite well. As an example, the Canadians recently announced in the summer at the G7 meeting that they would be doubling their climate fund. And something that I see as quite interesting there is a lot of those monies, in fact, went to supporting municipalities in countries like Chile to actually create the environmental standards to do things like municipal waste collection that could then be used, for example, for biogas projects to be developed in the country. And that pipeline was, as mentioned for Indonesia, was not happening simply because the waste was not being collected appropriately. As countries look to step up their game, particularly advanced economies, on how they can support these types of projects, I increasingly find that they're not looking to give free money away. They want their money to be used in a way that leverages that private capital and has a real, game-changing effect in the market. So there's real opportunity here in looking at those case-by-case examples, if you will. But I think perhaps the better word choice there is finding where the monies can be most appropriate to make things happen in countries. And this will, of course, differ across the Asian markets. But I think the opportunity is certainly there. And it's one that I would end as a real compliment to what Melissa was saying, that absolutely needs to be complemented by signals from governments as to what their long-term plans are on the energy transition. If investors still see 15, 20% returns on short-term investments in dirty assets, then what is the interest for them going into fixed-term assets that only deliver at 5 or 6%, right? We need to start sending signals to them as to what the expectations are.
Thanks, John. And this has been a very, very thought-provoking and engaging discussion. I'd like to thank all the panelists, Melissa, Fabby, Abhishek, and John, for the discussion. I'm going to quickly hand over to Gagan for a few concluding remarks to close out the session. Gagan, over to you.
Sure. Thanks, Arjun. Thanks again. And thanks for moderating what I thought was a really, really engaging discussion today. And particularly a bigger thanks to our panelists for being very forthcoming with your views. Today, what I felt was that we heard a range of opinions on several aspects of climate finance. And in a way, I suppose it's to be expected, as there are no easy answers to this most important of all challenges of our times. On the one hand, it was encouraging to hear how ESG compliance is not the only yardstick being applied from a corporate perspective. Examining underlying business activities from a sharper climate lens appears to be increasingly entering the discourse. Political economy was a term that also featured high in the discussion, as did political will, both perhaps especially relevant from the perspective of dealing with presently emitting thermal generation capacities. One of the other very important factors that emerged was the fact that capital appears to be a real constraint. And this cuts across countries such as India, which on the one hand has had more than a decade of RE deployment at scale behind it, as well as countries such as Indonesia, which are still in its early days when it comes from an RE perspective. And the role of foreign capital, the importance of foreign capital in plugging this gap was also emphasized. In some cases, it's the ability of this foreign capital to better assess risk. In other cases, it's simply the wide gap between the amount of capital that is required to meet national targets and in contrast, the rather shallow depth of the local sources of capital, which forces developers to seek out dollar debt to be serviced by local currency cash flows. Not very ideal. It was also good to see the discussion move beyond the power sector to electric mobility. This is a segment which some market observers feel may be on the cusp of a hockey stick type growth path, perhaps akin to what solar underwent in several countries the last decade. But above all, I think the one lesson that I took away from this is that emerging nations of South and Southeast Asia raise their climate ambitions. They can't afford to rely on overseas markets alone. And neither for capital, neither for manufacturing and supply chain, a balance is required. And on that final note, let me just close today's session. Wish everybody the best. Hope to see you again soon. Bye.
Thank you. Bye.
Oh.
Thanks very much, everyone.